Today we're diving into a hot topic in the investing world: leveraged ETFs in the utilities sector. You might have seen headlines about a 35% return in just 1 month. But hold on before you jump in. There's more to the story than meets the eye. Can you really get that kind of return with utilities? Is it a safe bet or a risky gamble? We'll break down exactly how leveraged ETFs like UTSL work, the potential benefits, and the huge risks involved. By the end of this video, you'll know if UTSL is the right fit for your portfolio, or if there are better ways to play the utilities sector. Let's chat. UTSL ETF is leading the pack with a 35.04% return in the last month. What's driving this impressive performance? UTSL ETF's recent surge isn't directly driven by the utilities sector itself, but rather by the mechanics of being a leveraged ETF specifically designed to amplify daily returns, both positive and negative, of the Utilities Select Sector Index. Let's break down the key factors at play. 1. Leveraged structure. UTSL is a triple leveraged ETF, meaning it aims to deliver 3 times the daily return of the underlying index. So, if the index rises by 1% on a particular day, UTSL would theoretically gain 3%. Conversely, if the index dips by 1%, UTSL would experience a 3% loss. 2. Daily rebalancing. Leveraged ETFs like UTSL use financial instruments like futures contracts and swaps to achieve their leverage. These instruments require daily adjustments to maintain the target leverage ratio, 3x in UTSL's case. This daily rebalancing is a crucial factor influencing UTSL's performance. Here's how daily rebalancing can drive UTSL's gains. Positive daily movement in the utilities sector index. If the index experiences a positive day, UTSL amplifies those gains. The ETF uses its instruments to capture the magnified returns, contributing to its impressive monthly performance of 35.04%. However, it's important to understand the other side of the coin. Negative daily movement in the utilities sector index. Even a small decline in the index can be detrimental to UTSL. The ETF needs to adjust its holdings through swaps and futures contracts to maintain the 3x leverage. These adjustments can result in additional losses, amplifying the negative impact on UTSL's share price. In essence, UTSL's recent performance is primarily driven by the leverage factor. The positive movement in the utilities sector index over the past month was magnified by the ETF structure, leading to its impressive gains. It's crucial to remember. This performance is not guaranteed to continue. The utilities sector could experience a correction, and UTSL's losses would be amplified. Leveraged ETFs are complex instruments with inherent volatility. They might not be suitable for all investors, especially those with a low risk tolerance. What is the underlying index UTSL tracks, and how does it differ from a standard utility ETF? UTSL tracks the Utilities Select Sector Index, but it functions very differently from a standard utility ETF. Here's a breakdown of the key differences. Underlying index. UTSL tracks the Utilities Select Sector Index, provided by SP Dow Jones Indices. This index includes domestic companies from various segments of the utilities sector, such as electric utilities, water utilities, gas utilities, independent power producers, and multi-utilities. Standard Utility ETF tracks a broader utility sector index, which could be something like the SP 500 Utilities Sector Index or the Dow Jones Utility Average. These broader indexes might also have a different weighting methodology compared to the Utilities Select Sector Index. Structure and performance. UTSL leverages the Utilities Select Sector Index by 3x. This means it aims to deliver 3 times the daily return, positive or negative, of the index. UTSL achieves this leverage through financial instruments like futures contracts and swaps. These instruments require daily rebalancing to maintain the 3x target. Standard Utility ETF passively holds a basket of securities that mirror the underlying utility sector index. The ETF's performance directly reflects the performance of the index, without any leverage. Volatility. UTSL. Due to leverage, UTSL experiences significantly higher volatility than a standard utility ETF. While a positive move in the index is amplified, so are negative movements. This volatility can be risky for long-term investors. Standard utility ETF, generally less volatile than UTSL as it directly reflects the underlying index. The volatility will depend on the specific utility sector index it tracks, but it won't be magnified like UTSL. Fees. UTSL might have higher expense ratios compared to standard utility ETFs due to the complexity of managing leveraged positions and the costs associated with using futures contracts and swaps. Standard utility ETF expense ratios are typically lower as they passively manage a basket of securities. Investment objective. UTSL, suitable for short-term, speculative investors who believe the utilities sector will experience a sustained upswing. However, this is a high-risk strategy due to the leverage factor. Standard utility ETF, ideal for investors seeking long-term exposure to the utilities sector with lower volatility and a focus on income generation through dividends. Many utility companies are dividend payers. How does UTSL achieve its 3x leverage, and what are the associated fees? UTSL achieves its 3x leverage through a combination of financial instruments and daily rebalancing. Here's a breakdown of the mechanics. Financial instruments. Futures contracts. UTSL uses futures contracts to gain exposure to the underlying utilities select sector index in a magnified way. A futures contract is an agreement to buy or sell an asset, in this case, a basket of utilities sector stocks represented by the index, at a predetermined price on a specific future date. Long futures contracts. UTSL primarily uses long futures contracts. This means the ETF agrees to buy the underlying index at a specific price on a future date. If the index price increases before the expiry of the contract, UTSL profits from the difference. This profit gets magnified, contributing to the 3x leverage. Conversely, if the index price falls, UTSL incurs losses that are also magnified. Swaps. UTSL might also utilize swaps to achieve its leverage objective. A swap is a customized contract between two parties where they exchange cash flows based on an underlying asset, like the utilities select sector index. These swaps can be complex and involve different variations, but essentially, they allow UTSL to gain synthetic exposure to the index's performance with leverage. Daily rebalancing. The key to maintaining the 3x leverage is daily rebalancing. Here's why. Futures contracts have expiry dates. UTSL cannot hold on to a single futures contract until its expiry to capture the magnified return. As the contract nears expiry, UTSL needs to roll it over to a new contract with a further expiry date. This rolling process involves buying and selling futures contracts, and these transactions can impact UTSL's performance. Market movements can cause deviations from the target leverage. If the utilities select sector index rises, the value of UTSL's holdings, including futures contracts, should theoretically increase by 3x. However, due to factors like fees and imperfect replication strategies, there might be slight deviations. Daily rebalancing helps UTSL adjust its holdings, through buying or selling additional futures contracts or swaps, to maintain the target 3x leverage ratio as closely as possible. Associated fees. Leveraging comes at a cost. Here are some fees associated with UTSL. Management fees. UTSL's expense ratio, which covers the management costs of the ETF, might be higher than a standard utility ETF due to the complexity of managing leveraged positions and the use of futures contracts and swaps. Trading expenses. The daily buying and selling of futures contracts and swaps to achieve leverage and rebalance the portfolio incur trading expenses. These expenses can eat into UTSL's returns. Tracking error. While UTSL aims for 3x the daily return of the index, it might not perfectly achieve that due to the factors mentioned above. This difference between the targeted and actual return is called tracking error. A lower tracking error indicates UTSL is effectively replicating the leveraged performance of the index. However, even a small tracking error can accumulate over time and reduce UTSL's overall returns compared to its target. What are the potential benefits and risks of investing in leveraged ETFs like UTSL? Leveraged ETFs like UTSL offer the potential for amplified returns, but they also come with significant risks. Here's a detailed breakdown of the potential benefits and risks to consider before investing. Potential benefits. Magnified gains. If the underlying index, Utilities Select Sector Index in UTSL's case, experiences a positive movement, UTSL can deliver significantly higher returns compared to a standard utility ETF due to its leverage. This can be attractive to investors seeking to maximize their profits in a short period. Hedging with short positions. Some experienced investors might utilize leveraged ETFs like UTSL for short-term hedging strategies. By taking a short position on UTSL, borrowing and selling shares with the expectation of repurchasing them later at a lower price, they can potentially profit if the utilities sector declines. However, this strategy is complex and carries significant risks. Potential risks. Magnified losses. The flip side of magnified gains is the potential for magnified losses. Even a small decline in the Utilities Select Sector Index can translate into a much larger loss for UTSL due to its 3x leverage. This can quickly erode your investment capital. Volatility. Leveraged ETFs are inherently more volatile than standard ETFs due to the daily rebalancing process and the magnifying effect on market movements. This volatility can be stressful for investors and lead to impulsive decisions. Erosion over time. Due to compounding effects of fees, tracking errors, and daily rebalancing, leveraged ETFs tend to underperform their underlying indices over extended periods. This means that even if the utilities sector experiences moderate growth, UTSL's returns might be lower than expected. Unexpected events. Leveraged ETFs are sensitive to market events and news announcements. Sudden changes in interest rates, energy prices, or regulations affecting the utilities sector can significantly impact UTSL's performance in unpredictable ways. Complexity. Leveraged ETFs are complex instruments that require a deep understanding of their mechanics and the associated risks. They are not suitable for all investors, especially those with a low risk tolerance or limited investment experience. How will UTSL's performance likely be affected by different market conditions? UTSL's performance is heavily influenced by two key factors: the movement of the underlying Utilities Select Sector Index and the leverage factor, 3x in UTSL's case. Let's explore how different market conditions can impact UTSL. Bullish market, rising prices. Positive impact. In a bull market where the Utilities Select Sector Index experiences a sustained upward trend, UTSL's leverage will magnify those gains. This can be highly attractive to investors seeking amplified returns. Example: if the Utilities Select Sector Index rises by 5% in a day, UTSL theoretically gains 15%, 5% x3. However, it's crucial to consider. Volatility. Even in a bull market, there will be periods of short-term volatility. While UTSL might experience amplified gains during upswings, these can be interspersed with periods of magnified losses during corrections. This volatility can be stressful for investors with a low risk tolerance. Erosion over time. Even in a prolonged bull market, fees, tracking errors, and daily rebalancing can cause UTSL's returns to underperform the underlying index over extended periods. Bearish market, falling prices. Negative impact. UTSL's leverage becomes a double-edged sword in a bear market. Even a small decline in the Utilities Select Sector Index can translate into a significant loss for UTSL. Example: if the Utilities Select Sector Index dips by 2% in a day, UTSL theoretically loses 6%, 2% x 3. This can quickly erode your investment capital. UTSL's performance in a bear market can be particularly risky due to potential margin calls. Some leveraged ETFs, including UTSL, might use margin financing to amplify returns. If the share price falls significantly, investors might receive margin calls requiring them to deposit additional funds to maintain their position. This can force investors to sell at a loss in a declining market. Investor sentiment. Bear markets can trigger panic selling, leading to further price drops. UTSL's magnified losses can exacerbate this effect, creating a downward spiral. Neutral market, flat prices. Limited gains/losses. In a stagnant market where the Utilities Select Sector Index experiences minimal movement, UTSL's performance is also likely to be muted. However, fees and tracking errors can still cause UTSL to underperform the underlying index slightly. Beyond market direction. Interest rates. The utilities sector is generally considered interest rate sensitive. Rising interest rates can make bonds a more attractive investment relative to utility stocks, potentially putting downward pressure on the Utilities Select Sector Index and impacting UTSL's performance. Energy prices. For utilities involved in natural gas distribution or electricity generation using fossil fuels, fluctuations in energy prices can affect their profitability and the performance of the Utilities Select Sector Index, impacting UTSL consequently. Regulations. Government policies regarding pricing, environmental standards, or infrastructure investment in the utilities sector can also influence UTSL's performance.